And as always, this video is brought to you by my programs on building your wealth. Specifically, the Wealth Path course is getting a complete re-overhaul over the next few weeks. We're announcing it probably next week, Monday. And what's going to be cool is it's going to come with so many more features, but lifetime access to the live streams will go away. But if you get in beforehand, you'll lock in lifetime access. So if you want to check out the programs now, lock it in before that coupon expires. We did have to extend it a little bit due to technical difficulties. But now, let's go ahead and jump into the good old content now that we've covered the fact that, yes, technical difficulties can happen, and we did extend the coupon code. All right, folks, take a look at this. This right here is an elevator with a piano on it. Yes, I had to show that to you. I don't know why there's a dude playing a piano inside the elevator, but I thought it was kind of funny. All right, next, inflation break-evens. So the first thing that I want to mention is this is the chart of 5-year break-evens. We've spent a lot of time looking at this chart before. Now, what's remarkable first is just from a technical analysis point of view, look at the bottom that we hit here where I just laser redded this, the bottom that we just hit in expectations. That is people's expectations, the market's expectation of inflation's trajectory, right? That it's going to trend down substantially here off of this peak over here in expectations of March, which peak inflation came about 3 months later. And that's why this chart is usually so powerful. This chart is usually so powerful because it tends to precede inflation and what inflation does by about 3 months. But take a look at this from a TA point of view. The bottom that we just hit literally bounces the top or marks the top of the 2018 inflation expectation cycle, which what's kind of scary about that is during this period of time, as these expectations were rising, you had Jerome Powell hiking, and to the point where Donald Trump was threatening to fire him, right? So while we were at these levels, Jerome Powell's hiking to the point where Donald Trump, a president at the time, is expecting to fire Jerome Powell. And that's literally what we celebrate now as a low of expectations, right? But there's another problem here. And the problem evolves a little bit. So let's look at this in a little bit more detail. So first of all, this chart right here shows you inflation expectations over just the last year. Over the last year, you could see how these inflation expectations have been plummeting. And part of this is because, and it is true, part of it is because we've seen, prices for commodities plummet, whether it's copper or lumber or memory chips. Samsung just reported terrible earnings on Friday. It's their first profit decline, I think, since the 90s. It was remarkably bad. DRAM prices collapsing, which usually memory chip prices are the first to sort of collapse in just sort of the semiconductor market. And so we have this massive peak here in inflation expectations in March. And again, that downtrend really aligning with what commodities are doing. This right here zooms out about 5 years, that first chart we saw there. So this is zoomed into 1 year. Now, here's what's remarkable about this chart is it makes it so clear. And this is, we're going to get into the part where this might start breaking apart. But what I want you to look at is here. Look at this peak right here in inflation expectations. That's March. Look at the peak here in actual CPI. That right there is June. So you see this 3-month lag in when you sort of get peak to peak. And we've seen these sorts of lags of the blue line being CPI peaking after inflation break-evens peak. And it's really quite remarkable because it's been very consistent over the last probably 20, 30 years. Let me see this here. This chart goes all the way back to 2005 is as far as 2004 is actually as far as we went back here. So about 18 years. So you can see this very remarkable correlation between the two, and you see that delay between the two. But then I got to thinking to myself, we rely so much on these inflation expectations to come down. We don't even, obviously, in this video, need to talk about the fact that, what happens if inflation does come down to 5% and then it stays there. And then the Fed, has a credibility challenge of, we said we were going to get it to 2%, even though it's coming down. We're going to have to be more aggressive, right? We don't even need to really talk about that in this video because that's a whole nother issue. But the other issue that we always want to consider, because I think it's so important to always pay specific attention to your Achilles heel. What are you so confident in that you might potentially be wrong about, right? And everybody always says, historically it's right, and the most dangerous words are this time is different. But, I don't like to believe that. I like to think that there are nuances to every style of recession and crash that we're in, so there can be differences, and we want to at least be aware of those. And so one of the things that sort of made me start pausing a little bit and thinking about expectations was this study that just came out from the Federal Reserve. They talked about how homeowners revise down their near-term inflation expectations and their optimism for the future of the labor market in response to labor market or mortgage rates when renters are less likely to do so. So really what you have here is you have a division. You have more apathetic individuals, people who don't really pay attention to mortgage rates because they don't affect them, and more in-tuned individuals, homeowners versus renters. And if that can meaningfully affect expectations to the tune of a study basically saying, oh yeah, homeowners absolutely are driving inflation expectations down, then it made me pause for a moment and think, my goodness, what if this fall in inflation expectations we're seeing here is by some degree because the markets believe that the Federal Reserve's tools are going to work, that the Federal Reserve believes they're going to get interest rates up high enough to bring inflation down. And so then markets believe it's going to work. So what do? They say, oh, well, we're just going to have pain for a transitory period of time. Let's just spend more in the meantime. Remember what I posted on Twitter and we talked about just a few days ago on the channel? We talked about the absolute explosion in consumer credit, which to some degree is a sign that people are sustaining their spending because they believe in a weird, twisted way that, this hiking is just going to be temporary. The Fed's going to have to pivot. Let's just spend more on debt temporarily. We'll get to the Fed pivot, and then we'll go back to the glory days. And it makes me pause thinking, what if we're wrong? Like, what if we're spending on credit, thinking the Fed's going to pivot, and then they don't? Or inflation expectations don't actually lead to the plummet in inflation or readings that we're hoping to see, right? And remember, folks, even if we just went to the lows of expectations now, we were still in a hiking regime over here. We were still in a quantitative tightening regime where the Fed was trying to roll off bonds and basically vacuum money out of the economy. So for part one, before we get to part two, pain, which I'm going to talk about in just a moment, this is going to be our little transition picture here. For part one, I think a really important takeaway here is a lot of things can affect expectations for people and for markets. And it doesn't, with 100% certainty, tell us that inflation is going to go down enough to where the Fed's going to pivot. Sure, maybe inflation will fall down and follow break-evens, but what if it's just not enough to where the Fed is so concerned about their credibility they keep driving things down? And people's or the market's expectations are skewed by thinking, well, we haven't had rates like this in 40 years, so it must bring inflation down, but it's going to be temporary. Let's just keep spending in the meantime. And then ironically, that let's just keep spending and borrowing in the meantime actually continues to keep inflation up, especially on services like travel, entertainment, whatever, right? It's scary. So there is a very real element to, yes, inflation will generally go down after inflation break-evens go down, but it could take longer this time around. And again, this isn't to play the this time is different argument. It's just to say if it does take longer, you're going to want to be prepared to be more patient in this market. And then this is where we got to talk about Amazon. And yes, this was back in my HVAC days. I saw this picture come up on my iWatch, actually. This is a photo of me back, probably 8 years ago, back in my HVAC days. You could see I was really good at heating and air conditioning with my good old 8-inch T there. Anyway, so what did I notice at Amazon? Well, one of the things that I noticed at Amazon, which was really, really interesting, wasn't this note here. I put a little cynical mark over here that I think they moved Prime Day into Q3, their Q3, instead of Q2 because they took their bad write-down for Rivian in Q2. They're like, that quarter's going to suck anyway. Let's just move Prime Day to the next quarter and have a good quarter afterwards. But I thought this was really interesting. We have slowed our, it's actually right under me here. There we go. We have slowed our 2022 and 2023 operation expansion plans to better align with expected consumer demand. Okay, so keep that in mind. Amazon is saying, hey, we're going to slow our expansion. So I thought about that, and then I'm like, wait a minute. On one hand, you're going to slow expectation, but then over here, you're actually talking about a subsequent step up in demand. So why are you slowing your expansion while you're seeing a step up in demand? So initially I'm like, that just seems like it doesn't make sense. But then it made sense over here. It made sense that they say there's a pre-spend to keep the pipeline moving. So when we make adjustments to the time horizon, the impact is not as great as you expect now, but instead it affects us later. So what they're saying is, look, right now consumer demand is up, but we actually expect consumer demand to go down. And so that's why what we're actually going to do is not only do we expect more normal shopping patterns, which is a way of saying lower shopping patterns for Amazon, but even though we saw a bump up in consumer demand recently, we are planning logistically and from an operational point of view. Come on. There we go. Jeez, I don't know what's going on with this PDF today. We are planning from an operational point of view to experience a slowdown. And so I thought that was very interesting because, and there's more to this as well, but it's really a warning to us that, okay, so for now, we could actually still see really hot consumer numbers because consumers expect inflation is going to come down, so they just borrow to keep spending. And Amazon's like, yeah, they keep spending. And so we look at these consumer numbers that are substantially lagging, and it's just spend. But it's actually really, really misleading because the true pain might actually be to come when consumers actually go, oh God, inflation's not going down as fast as we thought. And Amazon's starting to see signs of that potentially being true. This made me a little bit nervous as well. Now, I want to take a note at a few other things here. So they talk about AWS margins dropping. One of the things that we are seeing is that this constant belief that Amazon AWS is only going to grow might not necessarily be true, and that they're even making comparisons to the 2008 rough patch and how that time frame really prepared them for what they may see going forward, especially as customers, quote, optimize their costs and need help scaling down the amount of Amazon Web Services they use. That was kind of scary to me. I mean, I always like to write notes when I read these things. And for me, I wrote here, sounds to me like Amazon adjusted for higher spend now, but they're planning for spend to fall in the future, like in 2023. So they're beginning to slow their expansion rate and they're helping businesses scale back in AWS. That is really a sign that businesses and consumers tend to lag in pain because they use or are using debt to sustain their prior lifestyle. This means more pain ahead, and the real pain potentially, especially in earnings, hasn't happened yet. It might not if inflation falls substantially, right? We might not get that pain. But it might take it might take real panic to actually get that inflation to come down. See, and then I wrote, ironically, low inflation expectations kind of imply, hey, the Fed will U-turn, right? Let's just spend on debt, get through 2022, and we'll be fine. But those that are complacent could get whacked. And that's what I'm trying to warn you of. Like, don't be complacent, get whacked. Join the programs on Building Your Wealth, to where we go through these sorts of reports together. Every single day the market is open when I'm in the office. And we can actually learn together and find these patterns together. We do these daily. So now this was also interesting. They're still seeing advertising growth, but they're prepared for the potential optimization that could be to come. That's another element that's like, oh, okay, all right. And then they talked about, well, what about all this hiring that you had done? And they're like, look, we hired a lot more people than we thought because we thought Omicron was going to keep people locked down for a while. Now the variant ended up not being that bad, so people went sort of back to their normal lives. But now we're stuck with nearly double the head count, and it's kind of like, oh, okay, so you became super bloated with the expectation you were going to have a lot more demand, but that didn't follow through as much as you thought. You're getting back to normal levels, but now not only are you not at Omicron levels, you're at normal levels, but now you're also potentially planning for the real slowdown. Now, generally, Goldman Sachs, remember, it's worth noting, tells us that the bottom of the market happens 6 months before the bottom in earnings. So generally, the stock market doesn't bottom when earnings are at their trough. At the lowest point, the stock market bottoms about 6 months before that, which is still a moving target in terms of where that 6 month bottom is, that pre 6 months. Is it now? Was it 3 months ago? I don't know. So we'll see. Anyway, let me know what you think. Make sure to check out the programs on Building Your Wealth. If you need life insurance, go to metkevin.com/life. And if you want 12 totally free stocks, make sure to go to metkevin.com/Weeble. Get 12 totally stocks for free when you fund your account. It's a platform that I still use daily. Thanks so much for watching, and we'll see you in the next one. Goodbye.